Let's pause here and move forward with the Fed's path ahead. And to do that, we're going to bring in Joe Lavorgna, chief economist at SMBC Nikko Securities. Joe, good as always to see you. What is the path forward for the Fed here? I mean, as Steve pointed out, 5 members of the board see rate cuts next year of 100 basis points or more, coming down to 4.6% from 5.1% or maybe lower. What do you see happening?
Steve, I love the fact, and Steve, I like what Steve said, Tyler. I love the fact that directionally, the Fed is on the right path. They've got to lower rates, but they do not have enough rate cuts built into their forecast, in my opinion. I believe the Fed will go at least 150 next year. It needs to go a minimum of 250 basis points between now and the next 24 months.
They need to do this, or what happens?
Yes.
Or what happens?
You will have a much harder landing because that deep curve inversion, Tyler, is causing a potential credit crunch. You're seeing banks pull back significantly on providing credit. You're seeing the senior loan officer showing significant tightening of standards. It's a very slow burn, but the longer it happens where that curve remains inverted, and we're approaching now all-time records, to me, that will make the ultimate downturn worse if the Fed doesn't try to normalize that curve. There's some wisdom of crowds built into the long end of the Treasury market.
And you've been a believer, it hasn't happened yet, that we were going to have a recession this year, right?
That's correct. That's right.
And so you still believe it's just a matter of timing before it comes.
That's right. And the Treasury market, we avoided one last spring when the Fed added $400 billion in liquidity around the regional banking crisis. But here again now, the market is pricing even more cuts now than they were 12 months from where we were this past March. And I do believe the bond market eventually will be right, which means the equity market is wrong. Because the amount of easing the Fed needs to do to normalize the curve is not consistent with a soft landing. So I think the bond market is correct and the equity market is wrong, meaning the equity market will need to retrace its run up. Whether we go back to 33 or 3,400 S&P remains to be seen, but I do look for a weaker equity market in 24 based on a hard landing.
Karen.
Hey, Joe, it's Karen. So where do you think the Fed wants the real rates to be? And
I'm of the view, Karen, that the real equilibrium rate is a bit lower than what the Fed currently believes because productivity is soft, demographics are poor, and debt levels are high. So if the real equilibrium rate is closer to 0, maybe it's 50 basis points, it's sort of like pre-COVID type of readings, then the funds rate really should not be much above 2.25 in that scenario. So rates potentially have a long way lower to go.
So you mentioned the inversion. So this is, I think, historical in terms of the duration. And you go back and look, typically the longer the inversion, the more severe the downturn. But somehow people think, for whatever reason, it's different this time. Why would it be different? Or could it be worse than people are expecting?
It could definitely be worse than people are expecting. I don't look for a deep recession because I do believe the Fed will be cutting more than they are saying. In 2008, we had this debate in the spring. People thought we had avoided a recession. It wasn't even a deep inversion. And it turned out we wound up having a very deep and long recession. We don't know what the recession will look like. It hasn't started. And when you get into recessions, unfortunately, bad things can happen. And we could find leverage in places we didn't know existed. When that unemployment rate goes up and all of a sudden that leads to defaults, that could cause a cascading effect in other markets. So we just don't know. But yes, I do believe that the deep inversion, which, by the way, Guy, the record is 20 months. So that'll take us to February. So we're not past the record. But I do believe the Fed could avoid a deep recession and a hard landing if they were to cut rates aggressively, because most of the decline in inflation is transitory. This period, to me, looks much more like the 1940s than it does the 1970s. I think the Fed has made a major mistake in raising rates as far and as fast as they have.